Having fun with fun rates. Fun rates. Okay, the fun rates, guys. That's probably the first economic data metric that I ever looked at. I looked at the Bank of Canada, the fund rates over the years, over the past the trend for the past 20 years, and I had drawn a trend line. We could almost it pretty much Canada resembles the U.S. Funds rate, and I had drawn a trend line which looked maybe like this on the Canadian, or maybe like that, this one here. And I had estimated, I think we're back here, and I said whenever the fund rates are going to get above that trend line violation, I say, oh, that's it. We're going to be going back down. So what happens when the fund rates have to be brought back down? Well, you're already in a stage 4 decline. So there's always a pattern that's been happening before these declines. And let's examine that right now. And with no further ado, let's go to 2001. Okay, monthly candle chart. Here's your original breakdown, SPX. Pretty sweet. Test, go back down. So what's happening with the fund rate right at this first breakdown candle? We had already been flattening. So there was a cycle. Okay, everything's going good. We're going to start increasing rates. And right here, the market's not really telling you yet. Right here, that last hike right there. There's not really a delete. There's not really a big warning sign. Yeah, you're getting close at 12-month moving average. There's no closes below. But they started, okay, let's pause. Pause 1 month, pause 2 month, pause 3 month, and after that, pause 4 month. And then get that big wick down below that monthly define, or we're starting to find that monthly support. Price action comes back in, but now the more you're hogging that 12-month moving average, the more it's flattening out. And the next month after that, then we close. Did they continue pausing? No, as soon as you close below, you have already been paused for 1, 2, 3, 4 months, 5 months, and on the 6th month, when we're starting to go down, decrease in the rates, pull back up, but never going back above that monthly defined support and resistance. And now you're well below a declining 12-month moving average. And then it's just a classical top we see over and over. So this is probably the part that, even if we had that top pattern, I'm going to shoot over to the SPX. We didn't have that freeze of so we had a sharp pull down below that 12-month moving average, but we hadn't had that pause of interest rates yet. But now we are going to have, or we're being priced in that we are going to have that pause. So I believe now we're entering that plateau. So let's move on. What happens here? What happened in 2007-8? Okay, initial breakdown right here. And let's look at wow, already started pausing way before. Cool. So it was already starting to pause, and then we kept going up. Was there much reason to pause back then? Close above an inclining 12-month moving average, not really defying anything. So the pause did actually give a last leg up. Right here, we got a last leg up. So we're paused for how many months? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. 12 months. Wow. So for 1 year, we had paused. And let's look at the price action. Did it start falling before? We're still in the price action. They started lowering the interest rates. Maybe they got scared during the month, had that noise below that 12-month moving average, but it's still inclining, and you're still getting, so when they start decreasing, you're getting that push, but since they started decreasing when you're still above that 12-month moving average, you got to push up to create those all-time highs. But eventually, the reason for them lowering the interest rates, even after that push, the reality is starting to sink in. I'm going to overlay the recession charts, and we're probably going to see that we're starting a recession. Price action starts going down, and decreasing the rates. But you're still falling in that same type of pattern. Once that technical breakdown happens, look at that bigger top pattern. This is the bigger top pattern. Breakdown here, but this one's a bigger one. And we've already been decreasing the rates, but you can't stop it. Rates increasing, you're still in an ascent. When they start slowing it down, you get that last push, depending where technically the chart is. And after that, when they really start decreasing the rates, depending where you are, if you're still above the 12-month average, you get a push up. But if the price action is already starting to go down, you're getting a push up, but it's never quite as high to go back above monthly defined support. So I'd be fine to not even look at the funds rate. I could just look at top patterns, but they do help you. You really want to see them go flat. And if you really start them going down, then after that, you could try to pinpoint exactly the area where it's going to be more sound. So if they're going down and you're in an area below monthly defined breakdown, declining 12-month average, it's a very good sign that we're going to be in a bear market. There's a reason they're lowering the interest rate. There's some issues, and that could be a good entry here. If they start lowering the interest rates, but you're still above the 12-month average inclining, you don't want to go there, but you got to keep a close eye, because in eventual fall, after that, once you're positioned the price action below monthly defined support, which is now resistance, and you're starting to create a declining 12-month average, the subsequent interest rate cuts, you want to hop on board, because now you know that they know that there's a downturn and they're trying to offset that slowly by increasing interest rates. But you know that because the momentum, the trend, Stan Weinstein, but now a 12-month moving average on the monthly charts has turned downwards, that these aren't really going to help until the economy starts picking up, until unemployment rate starts turning over from high levels, and until you start closing back above the 12-month moving average. Then they start increasing later and later. So you can't rely on increases to know when the bear market's over, but you know that they're going to happen, and they actually confirm a decline. So there's always a decline of interest rates cut once you're declining. And sometimes it happens just a little bit before, but you know better. You're going to look at the chart pattern and you're going to wait. Okay, let's scoot over to today. Flat. Interest rates start going up. And right here, we didn't have the pause, the extended pause before this happened. So maybe that's some weight of evidence that I misread or could have taken into account. What we want is, I really want to wait. I want to see a pause. I want to see how the market's going to react to the pause. Because remember, before in 2001, in 2008, when they had that pause, the market kept going out for another high. So if this happens, if we close above that monthly defined breakout line, and it does continue during the pause, I'm going to want to wait until that price action starts closing back down below it. And when they start, after that, we're going to have that pause. After that, when they start cutting the rates in function of where it's going to bounce, after they do that rate cut, I'm going to decide if I'm below a decline 12-month average, taking this little position here. After that, when I close below monthly defined support, turn resistance, I'm going to take another position here. When each time they do the rate cut, I'm going to add on. So that's how I'm envisioning it now. Maybe this was a little early to in the cycle. The unemployment rate has still not turned over, actually gone down lower. So this could actually have a burst until we've really flattened out. And I really want to see a cut. For me, a cut is going to be the beginning of the end. It's going to give a last run up. I'm not going to short immediately, But a little while after, when technically we're safe below a declining 12-month moving average, is going to be the perfect time to short, because the following cuts are going to come over and over until this rolls down. So keep digging in. Right now, we're in a stage 3 on the SPX, in between defining monthly defined support. For me, this is just 3 candles. It's not the rally of the year. It's not. I don't do fear of missing out. I don't care. I'm just going to wait for the best opportunity by learning charts, learning history of the charts, seeing how the Fed's cutting rates impacts the stock market. And anybody could do that. Just go behind load and trading view and just scoot backwards and try to observe the combination. That's what the weight of evidence is. The combination of the price action, chart patterns, declining 12-month moving average, where they take actions and what happens with price action. Because everybody says, oh, they're going to cut the rates and it's going to go up. Well, you're going up, but you're not making higher lows, higher highs. So you're still in a downtrend. So this actually confirms, it's like kind of a contrary to what people might think. Rate cuts happen too late. You're already in downtrend. And they're nothing to worry. They're actually confirmations of a stage 4. So basing, flattening out. I want to wait. I want more basing of that wait. Let's hold. Let's wait and see. Let the market start turning over. Let them absorb that extra money or that pricing in that there's not going to be rate hikes. And when the pressures of selling come in and start lowering it, then we're going to enter when this starts, when we start having rate cuts, and depending where we're situated right here. All right, guys, having funs with Fed funds. Ciao, guys.